Hi, my name is Marc Chapman, manager of the HI European Equity Fund. Looking at the month of May, we see a reasonably sharp correction in the overall levels in the European equity market. In particular, the cyclical sectors of the market, automotive, technology, and materials, have declined quite sharply. For example, a bellwether automotive stock like VW has declined by more than 10%. The macro data coming out of China seems to be indicating a slowdown. And together with the trade wars, this is causing some concern in the overall market. Automotive volumes may be at a peak in the Europe and US and slowing down in Asia. Similarly, in the technology sector, inventories in semiconductor stocks seem to be at quite high levels. Expectations have been for a recovery in the second half. However, this may prove too optimistic. Now, looking at the overall macro picture, the obvious issue at the moment is whether there's going to be a recession in the US and a sharp slowdown throughout the world. The US 10-year yield is starting to signal that. However, the yield curve itself is somewhat manipulated. And so the signal from that may not be so clear. It may be that rising risk aversion is leading to a flight into the debt market. The weak oil price also indicates the same thing, a flight away from risky assets towards safe ones. Looking at the fund, during the month of May, the fund has been around stable in terms of overall NAV. Earlier on in the month, we reduced the gross exposure from 120% to a low of 70% to reflect the fact that the upside in our long book had diminished somewhat over the previous few months. And during the month, into the market weakness, we've been taking profit on our individual short positions. These have been in some growth names and some cyclical type names in the mid-cap space. In the last few days of May, we've seen the sell-off accelerate, and we now see good upside on some of our interest in mid-cap names, where previously we've sold out of. We now think are looking quite good value. The upside on our long book is now over 40% again, which has historically been a good indicator for adding risk. Into further weakness, we'll look to add to interest in names which have a strong structural growth dynamic and where we think performance can be very good over the midterm. Thank you very much.